Ladies and gentlemen, good day and welcome to DCW Limited Q4 FY-2025 earnings conference call hosted by Arihant Capital Markets. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashwath Rajan. Thank you and over to you, sir.
Thank you. Hello and good afternoon to everyone on the call. On behalf of Arihant Capital Markets, I thank you all for joining for the Q4 FY-2025 earnings call of DCW Limited. Today, from the management, we have Mr. Satvik Jain, President, Mr. Amitabh Gupta, Chief Executive Officer, Mr. Sudarshan Ganpati, Chief Operating Officer, and Mr. Sudipto Mukherjee, Chief Finance Officer. So, without any further delay, I'll hand over the call to Mr. Satvik Jain for his opening remarks. Over to you, sir.
Thank you, and good evening, everyone, and thank you for joining us today for our earnings call for Q4 and the financial year 2025. FY25 was a year marked by persistent volatility in the global chemical industry. As we entered the final quarter of the fiscal, the challenges only intensified. From muted global demand, especially in Western economies and China, to continued pricing pressure caused by surge in low-cost imports, again particularly from China. A sharp drop in ocean freights out of China, in part due to the trade tensions with the US, further enabled Chinese exporters to price more aggressively, especially into markets like India. The geopolitical shifts only added to the woes, including potential US trade tariffs and shifting alliances, causing disruptions in traditional trade flows and raising uncertainty. The influx of cheaper imports has put pressure on domestic pricing environment, especially for basic chemical products like PVC and soda ash, where we've seen margins being squeezed despite healthy underlying demand. On the policy front, while the much anticipated anti-dumping duty on PVC has been delayed, we remain hopeful that the government will act soon to ensure a level playing field for domestic manufacturers is restored. That said, even in this tough operating environment, India remains a structurally growing market, and we are encouraged by the year-on-year demand growth across most of the segments that we serve. This long-term demand visibility, coupled with our execution capabilities, is what gives us the confidence as we move ahead. Coming to our performance, despite pricing headwinds in our basic chemicals portfolio, I am proud to share that our company has delivered a resilient performance with a 12% EBITDA growth over the last fiscal. This has been driven primarily by the strong momentum in our specialty chemicals business, which now forms a much more meaningful part of our earnings mix. More importantly, with our ongoing efforts to reduce financial leverage and bring down our borrowing costs, this growth in EBITDA has translated into a 100% increase in our profit after tax. In fact, for the first time in several years, we've brought our net debt to EBITDA to below 1 times, which marks a critical milestone in our journey of financial strengthening and balance sheet discipline. Operationally, we have also made strong progress on our strategic growth plans, and our forward-looking investments are beginning to take shape. Our 30,000 tons CPVC capacity expansion at our Saupram site is progressing ahead of schedule. We expect to commission the first 20,000 tons of this incremental capacity before the timeline of September 2025, which will give us a meaningful step up in our specialty volumes for the second half of FY26. Our alternate energy project has been commissioned and power generation will be scaled up in phases. This initiative will help optimize energy costs, improve our carbon footprint, and reduce our dependence on traditional sources of power over the long term. On the export front, the demand of synthetic rutile is slowly picking up. we have secured large volume orders from our Japanese customer base, which is a positive sign for the recovery in this segment. As we enter FY26, we believe that the second half of the year will hold stronger tailwinds, especially as the capacity-led volumes from our specialty projects start coming on stream. While near-term market dynamics may continue to fluctuate, our strategic direction is clear. We will continue driving growth in value-added specialty chemicals, where margins and customer stickiness are higher. We will extract operational efficiencies across our core basic chemicals platform. We will continue to delever our balance sheet and internally fund our growth capex over the year. And most importantly, keep building a more resilient, high-quality earnings base for the long term. You may have noticed a change in the way we are presenting our business segments this quarter. We have moved from a product-level reporting to a more consolidated view across two broad verticals, which are basic chemicals and specialty chemicals. This change is both strategic and reflective of our journey as a company. It allows us to highlight the growing contribution and momentum of our specialty chemicals segment, while also aligning with best industry practices for competitive positioning. We believe that this will help investors better track our evolution into a more value-accretive, margin-resilient portfolio over time. While FY25 was a test of resilience, FY26 will be about execution, delivering on our projects, maintaining our financial discipline, and capturing margin upsides as the markets normalize. With a stronger balance sheet, visible growth levers, and a sharpened portfolio, we believe that we are well positioned to deliver sustainable value creation for our stakeholders. I request our CFO Pradipto to now take you through our financial performance. Over to you, Pradip.
Thank you, Satvik. Good afternoon and welcome to the Q4 FY25 earnings call for DCW. The revenue for the quarter stood at 538 crores, which was a 13% decline from Q4 of FY24 of rupees 621 crores. While the revenue from the specialty chemicals stood firm at around 125 crores, which is in line with Q4 of the previous fiscal, the basic chemicals segment clocked a degrowth in revenue, predominantly due to weak export demand and lower realizations from one of our products, synthetic rutile, and a 8% reduction in net realizations from soda ash. On sequential basis, the Q4 revenues were higher by 13% for the quarter. For FY25, the year as a whole, the revenue for the company clocked at 2,000 crore, up by 7% from 1,870 crores in FY24. The specialty segment revenue grew to 526 crores from 368 crores, a growth of 43% on back of increased capacity led by capex from Q4 of FY24. The basic chemicals, however, declined 2% to clock a revenue at 1,463 crores. It is important to note here that the production and sales volumes for all the products constituted in the basic chemicals have increased across board, including synthetic rutile, but the effect of the same could not be witnessed due to sharp fall in average realizations in SR and soda ash. The EBITDA for the quarter clocked at 62 crores, a dip by 10.5% from 69 crores in Q4 last fiscal. The EBITDA from specialty segment again remained firm at 46 crores, while the basic chemicals degrew to 14 crores from 21 crores, a fall by 33%. This fall in basic chemical EBITDA for the quarter was due to severe pricing pressures on export sales of synthetic rutile to China and a 7% dip in prices of soda ash. On sequential basis, the EBITDA for the quarter was same at a level of 62 crores. For the financial year FY-2025, the EBITDA stood at 217 crores, a 12% increase over last year of 194 crores. The specialty EBITDA grew to 189 crores and an increase of 41%, but the basic chemicals EBITDA dropped to 19 crores from 47 crores, a drop by 59%. This fall is due to the sharp fall in NR for SR and soda ash, as earlier mentioned, despite clocking higher sales and production volumes. The finance cost has been in a declining trend across quarters, and at the end of the year, the finance cost stood at 67 crores. That is a reduction of 8.5% over FY-2024 numbers of 73.5 crores. This reduction is despite a borrowings of 80 crores to fund the ongoing CPVC capex. With 12% EBITDA growth coupled with 8.5% reduction in finance costs led to achievement of a profit after tax of 30 crores, that is doubling of the PAT recorded in FY-2024 of 15 crores. With this, we'll just walk you through certain key ratios. The current ratio for the company stood at 1.08 in FY-25 end as against 1.13x in March 24. The asset turnover ratio, which is the asset sweating for FY-25, stood at 1.5x versus 1.4x in FY-24. For the leverage and the cash position, the debt equity ratio stood at 0.4, almost at par with 0.4 of FY-24. The outstanding term loan stood at 366 crore as against 420 crores in March 24, thereby a reduction of 44 crores. It's important to note that our scheduled repayment was made of 124 crores and a fresh borrowings of 80 crores were made to fund the ongoing CPVC capex. Short-term borrowings stood at the year-end at 59 crores, which was at 27 crores for March end 24 and increased by 32 crores. The company is maintaining a healthy cash and cash equivalent of 215 crores, which is also gone up by 46 crores from March 24. The net fund-based debt to EBITDA ratio for the company at a year-end 25 stood at 0.97, below 1, as against 1.4 in FY-24. This eventually means that the company is in a position to pay off its entire debt with next 1 year of profits. The company's net debt EBITDA ratio below 1 has been achieved in FY-25 despite the depressed commodity cycle. Over the last 10 years period, if we see this number going below 1 was once in FY-23, in a year when the commodity cycle was its peak. This demonstrates the company's continuous drive to deleverage itself and also expand across its specialty chemical segment over the past few years. On the return ratios, the EBITDA margin stood at 11% as against 10.5% last year, and the ROC stood at 8% versus 6.7% for FY-24. The interest coverage stood at 1.73x versus 1.36x for FY-24. With this, we would want to open the floor for question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pujan Shah from Molecule Ventures. Please proceed.
Hello.
Yes, please.
Yeah. Hi, sir. First of all, good set of results in the specialty segment. First of all, just wanted to get can you just provide us the segmental sales and EBIT breakup for the basic commodity and specialty commodity?
You sent your questions via mail. The basic idea was basically to now present the numbers as basic chemicals and specialty chemicals, as opposed to giving information at a product level. Obviously, if you would want those information, you have to send it across via mail. We would. Hello.
Hello.
Yes.
Yeah. Sorry for the disturbance, sir. My first question would be on the CPVC side. So if we look at the recent imports, blended imports, it would be around 150 to 160 rupees per kg, while our domestic realization remains at 120 rupees a kg. So could you just explain the difference, why it holds? And is that a visible uptake in coming quarters in specific CPVC segment?
No. The average price realization for us also is in the range of 140 rupees. So this 120 rupees price from where you got, I don't know. Even our realization for the year as a whole is 140 rupees. So it is always a blended realization what we give.
Right, sir. Right.
And when someone is buying at a higher price, why should we sell at a lower price?
Yeah. That's my question. But on a blended side, I was looking at a few of the imports.
No, you have said that it is coming at this price. If someone is importing with a waiting time of 2 months and all, why should if we are selling at 120 rupees, why should he import at this price? I think something is wrong with your database. I think we are selling at 140 rupees. That is the price X works to us.
Right. So basically, if we check on a spread level, we are getting a spread of 80 rupees as of now, right? 70 to 80 rupees.
How can you say it is 70 to 80 rupees? On what basis?
So if we considering the PVC prices and the CPVC, which is right now at 140, so blended, what we can see is that right now the PVC prices we are at 70 to 75 rupees. So
that is not the way to count. We have to only see what is our EBITDA spread. It is around 35% is our approximate EBITDA margin. You cannot exactly correlate. Today the price becomes 60 rupees and if I sell at 140 rupees, 80 rupees is my margin. That is a wrong way to calculate.
Okay, got it. And sir, we have seen a soften in terms of utilization in SIOP, and always in H2 we have been very strong in SIOP segment. So could you just help me to understand on that broader aspect?
Talking about the production realization, production numbers.
Yeah, we are utilizing 84%. While on
SIOP consists of, I think, more than 12 or 15 grades. And the cycle time for the grades are not always consistent. Some grades takes longer time to produce, some takes shorter time to produce because it's a batch process. So the production for the quarter will, to a great extent, will depend on what sort of grades that are being planned and produced. So you will not find the consistent numbers in SIOP. Some months will produce more, some months will produce less based on the product mix. Hello? Hello, I am not able to hear you.
Hello?
Sir, could you please sorry to interrupt, Mr. Pujan. Actually, your voice is not clear. Could you please rejoin?
Yeah, sure.
Okay, thank you. Before I take the next question, I would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Krish Kothari from Shinobi Capital. Please proceed.
Hi, can you hear me?
Yes.
Yeah. I actually wanted to, slightly sort of talk a little more longer term. Do you have any projections or guess on when your specialty division will become the largest division in the company, basically bigger than your basic chemicals division?
In terms of revenue, it will never.
See, our commodity predominantly is at a capacity of 1 lakh tons spread across soda ash, caustic soda and PVC. For specialty volumes, obviously, is much lower. The idea of getting into specialty for the organization was to bring stability to the bottom line and avoid the impact of cyclicality in the basic chemical prices. That has classically played out this year because if you see the basic chemical prices have been sulking for the last 6-7 quarters, and our major share of profit or EBITDA has come from the specialty business. Our future investments, as per our plan earlier communicated at various forums, is coming into the specialty, namely in CPVC, which is now into public domain, where we are getting up from 20 KT to 50 KT. We would concentrate in making our future investments mostly into the value-added products rather than into our the basic chemicals. So from a EBITDA standpoint, we have already crossed, we are around 90% of the profit comes, at least last year, came from specialty. But this obviously would undergo a change as the commodity prices go up, because the commodity prices going up will have a significant impact to our bottom line, because there are scales of 1 lakh tons which are available with us, which we are producing and selling.
Got it. And sorry, please continue.
Yeah, I think that was, trying to answer to your question.
Right. And just on this, so on your in terms of capex plans, do you, other than maintenance capex, do you anticipate any meaningful capex on the basic chemicals division in coming years?
So as of now, sir, we have made a communication a couple of months back from CPVC taking from first 10 to 20 we had completed, and then from 20 to 50 KT, and that is basically operational. So far as growth is concerned, we are from a basic chemicals, which is basically the PVC, the soda ash and the caustic soda, we are continuously doing certain investments into cost savings initiatives, apart from the routine capex or the maintenance capex which we do, which definitely would pull down our cost, thereby enabling profitability at lower prices of commodities as well.
Okay. And just last question on, again, slightly longer term. Do you think there's any scope to either, shut down or sell some of these basic chemical lines? I know it's very difficult to commit to anything right now, but I'm just saying, is that even potentially something that could happen in coming years?
See, I think PVC and CPVC, PVC and caustic, these are into our south facility and they are synergistically integrated into the plant. So far as soda ash is concerned, it is the only basic chemical which is done in Dhangadra Chemical Works. But that as a business roughly gives on a period of 4 to 5 years a 20 to 25% margin to us. Maybe since these are couple of years when soda ash prices are also coming down, government support of MIP has come in, the numbers are not showing up. But there has been years like FY-2023 where we have done an EBITDA of 75, 70, 80 crores to be precise from the soda ash facility. So in an average 5-year plan, if you see, soda ash gives an EBITDA of north of 20%, which maybe my PVC or CPVC fails to give at times. So I think we may not add capacity into the the basic chemicals, but the question of selling off has not crossed our mind as yet.
Understood. Okay, thanks so much.
Thank you.
Thank you. The next question is from the line of Manan Mundar from Walford PMS. Please proceed.
Yes. Can you hear me?
Yes, please.
Yes. Hello. So my first question would be on the guidance. So when we had last met, we spoke about having a base case scenario of around 400 crores in FY27 based on the prices at that time. So do you think we are still on track for that, or could there be any deviation in that?
So we have clocked a number of 220 odd crores this year. I think we are yet to see revenues from 30 KT of additional CPVC, which we have already mentioned. As Mr. Satik Jain also told, the power facility on what we invested last year, he will give its benefit this year. We would also have the capacity debottlenecking in our soda ash facility, where we were a bit sulking on because of a mechanical failure. This put together, plus our endeavor into last 5,000 tons of sales of SIOP, which can max out our capacity, with certain efficiency capex is what we are doing. I think 400 crores of EBITDA looks quite likely.
Okay, understood. That was my question. Thank you so much.
Sure.
Thank you. The next question is from the line of Sanjeev Damani from SKD Consulting. Please proceed.
Namaskar, sir. Am I audible?
Namaskar, you are audible. Please go ahead.
Sir, did I correctly heard that likely EBITDA this year would be 400 crores?
No, it was an FY27 guidance what we have given.
Okay. Thank you, sir. Second question which emerged from your saying that you have debottled soda ash plant. So would we be augmenting the capacity of soda ash plant this year, and the old problem is now over because some mechanical failure was there and we were not able to utilize, and some parts were to come and get us repaired to make it normal. So Can you give status on this?
Yes. So we have clocked a capacity of 80% this year for the full of the year with our existing stopgap arrangement, in absence of our the compressor which was supposed to come from Germany. That has arrived, and we are only trying to look at an opportune time to make the replacement of our setup with the MAN compressor. However, we are also looking into an opportunity of augmenting the speed of the existing setup so that we can continue with the part which has come as a backup with us, so that we don't lose time on the changeover, because that takes around 25 to 30 days.
Okay. So our capacity will remain the same of soda ash. No augmentation of the installed capacity.
No, I think our capacity roughly is 1 lakh ton, plus minus 5%. So that remains the same. We were operating at 80,000 tons because of these challenges, which we think we should get over by this year.
Okay, very nice. So the current scenario about soda ash prices, can I understand from you, sir?
Yes.
How is the...
Good afternoon. Well, as Mr. Pradipto said, our capacities, which is about 100,000 tons, we will be achieving a production of about 95,000 tons this year, a growth of almost 20%. And of course, we are working on improving on our net bags, because like anti-dumping duty application has been filed against some of the countries like Turkey, China, who have been dumping the product at very low prices. So we hope the bottom line also will increase, and our top line also will increase because of increase in the production.
Thank you very much. Now I'm coming to one suggestion that you had given, that we will be using our own PVC for manufacturing CPVC. So some development has taken place there?
I think we are working towards it. We have been fully using our own PVC into CPVC. The incremental capacity which is coming would also use our PVC into CPVC. It's always been the first technology setup which did not allow us. For the new capacities, it's obviously are all PVC going into PVC.
So will we be using our own PVC here onwards or after some time?
We had been using as well. We are using, and we will use it for the additional capacity also.
Okay. Sir, how is the pricing scenario of PVC? Because we have seen that in our commodities business, the margins are very thin, sir. Means that is including everything, caustic soda, soda ash and PVC everywhere. We have made very meager profit. So are things improving from this year in that segment, caustic soda prices?
As told by Mr. Satvik Jain, PVC currently, because of this US-China trade war, China is pushing a lot of volumes into India at a very, very dump price. This is having an impact on the PVC price, and as we talk now, the prices have come down, but we are hopeful that going forward, the prices have bottomed out and the prices will only improve from now on.
Thank you very much, sir. I am obliged. Thank you.
Thank you.
Thank you. Before I take the next question, I would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Pujan Shah from Molecule Ventures. Please proceed.
Hello.
Yes, please.
Yeah. Sir, continuing with the previous question, so in caustic soda, I am specifically talking about the synthetic rutile. So what happened in this specific quarter that the realization has been drastic? The realization has been fallen so drastically, and
yeah, please continue.
Yeah. And just wanted to understand on a broader aspect, then in next 2 years, how is the order book in terms of SR, and how's the outlook going forward?
So we take questions one by one. Your caustic soda prices, I think we are seeing green shoots in terms of prices going up for at least the quarter which went by compared to quarter 3. The prices have been increasing. Our challenge obviously has been softness in export in synthetic rutile, which is a part of the earlier caustic soda division and now basic chemicals. The quarter 4 profitability for the basic chemicals were impaired despite some price increase for caustic soda was predominantly due to liquidation of inventory so far as synthetic rutile is concerned into a more volume generic market, which is China, which is not our usual market because of lack of demand in our existing market like Japan, at least for in quarter 3 and quarter 4. That had a hit into our EBITDA. That obviously will get corrected because now, as Mr. Satvik Jain mentioned, we have contracted for 70% of our annual productions of synthetic rutile into the base market, which is Japan, and we hope that the rest of the volumes plus the inventory what we are carrying, a part of that would also get liquidated. So in that, our performance for the basic chemicals with this contract of 60-65%, 70% of our volumes being signed with Japan market will anyway show a uptick.
So I just wanted to know the context. So what the price decrease have been happened? So can you just tell me in terms of percentage?
I think, the usage of synthetic rutile defines the price, and the geographies define the price for us. We sell synthetic rutile to a more evolved market, which is Japan, where we can command prices, which goes into metal. However, if we do not, I mean, for a long 3-4 quarters, we have not been getting, we are unable to crack the orders for the metals for Japan because there was an inventory correction which was on play. We have got the customers on board from this year, and we were forced to sell the produce of us into the Chinese market, which obviously we could not command good prices. And hence there has been a suppressed EBITDA so far as the basic chemicals.
Okay, sir. I just wanted to know, we have preponed the capex line for the CPVC. So what are the timelines now, and when are we planning to commission the next 30,000 capacity?
So we had communicated when we made it public, we told that this 30 KT will be divided into two parts. 20 KT comes on board by September 25, thereby giving benefits from H2 of FY26, and the last 10 KT comes by March. We are, as of now, as Satvik is told, that it would get, we are preponing in the sense that we will do the commissioning bit earlier. We as a management think that we could compress the timeline by a couple of months from each of these respective timelines which get communicated.
Right, sir. But any specific, like in a month when we are planning to commission, so that it once it ramp up the full utilization, the full benefit can be utilized for the specific segment?
My friend, there is a difference between commissioning and commercialization. We may give you a date of commissioning, which depends on the plant's performance to complete the capex. The commercialization obviously would happen about we placing that 20,000 volume into the market. And as you may be aware, that CPVC is a bit customer specific and not as generic as PVC. So we would obviously we have encouraging first-hand information from the plant that the commissioning will go up, will be ahead of schedule. And basis that we are also, our marketing team is obviously, getting ourselves groomed for that couple of months of early commissioning so that we can place the volumes. But to give a timeline would be difficult, but it would be earlier than what we had communicated, which is September 25. Before that, we will be commercializing the additional volumes as well.
Right. And sir, my last question would be on the PVC side. So we have seen a downward trend in terms of pricing in PVC, and even the larger guys are talking a degrowth in terms of volume in FY26 due to depressed destocking issues. So what's our expectation in this segment going forward? Will this FY26 be a muted year for us?
See, placing a volume has never been a challenge so far as PVC is concerned for our company. I'll leave it to Mr. Ganpati to answer that, our CEO. So, but just we have always been all throughout the history been producing and selling 1 lakh ton. Ever since we had the capacity, irrespective of any market. Now we also have an advantage of utilizing our produce of PVC into the incremental CPVC volumes. So the net leftover, which is around 40, 50 or 60 odd thousand tons, I don't think should be a challenge in placing. It basically is a VCM to PVC spread, which has a hit into our P&L. But let's Mr. Ganpati answer.
I have not understood from you. What you are talking about degrowth?
So degrowth, destocking, not degrowth.
I was not clear about your question. That's why I am asking about.
Same question. So we have witnessed a pricing, the downward pricing in terms of PVC, right? And
yes.
Even large size of PVC players have been downgrading their volume growth for FY 26. Now, just your
Whom are you referring to? If you can be more specific, I'll be very obliged.
For specific.
Why I am telling you, because nobody is talking about a degrowth in PVC. Everybody is talking about 6%, 7% growth in PVC.
Yeah.
Whether the growth is happening at a right price or at a depressed price is what we are discussing.
Right.
Nobody is talking about a degrowth in PVC. This I am again emphasizing. The only thing is that because of higher quantities getting dumped from China, there is a pressure on the price. I don't think there is any question of the PVC demand not growing.
Right. Got it. I think that is from my side. I will join back in the queue.
Yeah. Thank you.
Thank you. Before I take the next question, I would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Amit Kumar from Determined Investments. Please proceed.
Yeah, thank you so much for the opportunity. Can you hear me?
Yes, please.
Yeah, so just one point. I mean, of your specialty chemicals, business, what is, the export share in that business?
So, specialty business comprises of CPVC, which is 100% domestic. There is another part which is SIOP, which gets clubbed into a specialty business. Of that, our capacity is 28,000 tons. We have produced and sold roughly around 25,000 tons. 60% of that is export, 40% is domestic.
Okay, and how much of this would be, export to US, if any?
Around almost 60% is export to US.
So I'm just trying to understand, now with this, new tariff regime, in play, all the, and there is a question of, later on, we don't know what happens to the eventual sort of tariff level, but, 10%, right now for the first quarter. So, how is this 10%? How much of this is you are paying and how much basically the customer is bearing? Is there a sense on that, at all?
Well, I think partially you answered your own question. Because of the uncertainty of the tariff in US, nothing can be said with guarantee. But then, all said and done, we will always have an edge over China, who is the next main exporter to US. There is going to be a delta between the duty from India and the duty from China. So I think there is nothing to worry about. And frankly
this is what I'm trying to understand, that, what is the, I presume that volumes sort of continue to flow. So, the negotiation that you are having with your, US customers, given that, it's a fairly large, share of exports of, SIOP.
Yeah.
So that, 10% tariff, is that entirely being paid by your, customers, or are they asking for some additional discounts? What is the proportion of those discounts vis-a-vis pricing that you have seen previously?
I will tell you, like this iron oxide business, it is not like basically this is red and yellow, and it is not that any red and any yellow can be used by all and sundry. Like the buyer, he fixes up a particular shade in his formulations, and even if there is a price advantage, disadvantage, they don't change their formulations on a daily basis or monthly basis. So frankly speaking, of course the price pays a very important part, but then the particular product which they are using in their formulations, they determine what are going to be the export from which country. And I think that is where, I will not say we are protected, but that is what gives a steady tonnages to our business. So
I understand that. I mean, I think you're sort of missing, I'm just, you are sort of talking about volume. So I understand. I mean, the customer relationships would be there and, product would sort of continue to flow. The point which I'm just trying to understand is that, purely from a pricing perspective, which is the net pricing that you get, I mean, does this 10% tariff change anything at all?
Yes, it may. Hi, Pradipto. There are a couple of things. First of all is that there is a tariff on India of 10%. As Mr. Amitabh Gupta also told, the other major supplier of SIOP to US is China. Then we should compare that China's price to US will increase by 30%. So we have a pricing advantage to play. That is a disadvantage. That's number one. But we don't know how it will shape up.
No significant impact in that sense on you, basically.
So the question is, I think what we as an organization house feel that it may play out to our advantage. However, having said that, there are a couple of things like in pharmaceutical where you have a API going into formulation, the SIOP also, because there is shades, it also has the formulation to be made with a front-end customer. They usually do not change for a 5-10% volume advantage. Let's say if Chinese imports into the US increases by 30% and ours by 10%, let's assume that that is the case, because we all are guessing what would happen, because certain products are also exempted. Like we have first-hand information that SIOP is exempted. But even if that plays out going forward because of whatever uncertainty, for a 10-15% price advantage, a customer at the front end will not try to induct a new customer and incur cost in stabilizing their formulations with a different SIOP, is what we are trying to say.
Okay, understood. Now, just a small follow-up on this. So, your capacity utilization in SIOP sort of seems to be already hitting close to 90%. So you said 28,000 capacity and 25,000 what you have already produced in fiscal 25. Almost sort of hitting capacity. So any sort of capex plan there?
The capex so far as SIOP may not come immediately so far as volume growth is concerned. It is more about moving up the value chain. So our applications of SIOP, we've started with products whose applications are in some cases at a very base level. We're trying to make small investments where we upgrade the product and the applications go into higher applications are possible, which also opens up newer markets. So we are very encouraged with the opportunity so far as SIOP is concerned, and we would not wish to make it public at this stage. Thank you.
Okay, all right. Thank you. Thank you so much for the detail.
Thank you. The next question is from the line of Pranav Jain from Ageless Capital Finance. Please proceed.
Hi, sir. Am I audible?
Yes, please.
Yeah, I just wanted to ask, would it be possible to tell me how much chlorine we get as a byproduct out of the manufacturing of caustic soda and how much PVC and chlorine is put into the making of CPVC?
It is a general norm, about 0.88% of the caustic production is what you get as chlorine. Our chlorine is basically being used as our synthetic butyl plant as hydrochloric acid. Okay. And frankly, whatever chlorine goes in CPVC, practically 50% of it comes back as the hydrochloric acid, which has to be marketed.
Got it, sir. So, and how much of PVC goes into CPVC?
How much PVC?
No, so basically the coefficient is 0.8 is to 1. So eventually as the volumes for CPVC increases, our PVCs will get diverted at that proportion to make CPVC.
Got it, sir. Thanks a lot.
Thank you.
Before I take the next questions, I would like to remind participants that you may press star and one to ask a question. The next question is from the line of Pujan Shah from Molecule Ventures. Please proceed.
I just wanted to understand the caustic soda piece. So as of now, we know that the domestic players have recent, the ECUs remain in the range of 34, 35. Do we earn higher ECUs due to internal consumption of chlorine, or we are in the similar ballpark range?
ECU of DCM Shriram is 29 rupees.
You see, ECU changes from manufacturer to manufacturer depending upon the location and everything. Like, I will not take the names, but some of the players from the West, the large producers, their ECU is hardly 28,000-29,000 rupees a ton. Okay, because depends upon how much they are using on chlorine, how much they are gaining on caustic soda. But then ECU of roughly 32, 33 is what we are pitching for. I cannot comment on ECU of in general because it will, as I told you, it will depend upon location, placement of their customers, so many things.
Got it.
And end of the day, the international prices of caustic soda, which plays a very important role, because whether we like it or not, the domestic prices are influenced by the international pricing of caustic soda. And all said and done, India exports quite substantial quantities of caustic soda now. Okay.
Right, sir. Yeah, got it. My last question will be pertains to the CPVC side. So we know that few applications have been emerging, let's suppose like fire sprinkler system. Assuming that the adoption goes as what we have been expecting, so what could be the volume, incremental demand in terms of volume can be opened up? Can you just quantify in terms of demand?
No, I can only tell you that in a house there is one bathroom, there are 3 rooms. So if the fire sprinkler application gets accepted, it is anybody's guess what will be the demand. It could be 2x, could be 3x. So it is a number which will evolve because it involves lot of approvals that we have to get from various state departments apart from the central government. So I believe it will grow gradually because initially the most of the tier A metros will get the approvals first, and it will gradually flow to the other cities. So I think that the demand growth can be multiple than what we are seeing purely on a plumbing side.
Got it, sir. And my last question would be on the soda ash. So, as we know that there is an anti-dumping duty will be levied by the government in coming months. So, as of now, there is a muted demand and cheaper imports being dumped in India. So, do you think that once the ADD is levied, we expect our EBITDA margins to be at 18-20%?
See, the EBITDA margin for us for this year is not a reference. If you have to see what was our EBITDA margin for FY-23, you would see it was north of 20%, where others were doing maybe 25-26%. We are a 1 lakh ton capacity landlocked in Gujarat as a facility. So, and we are very well benchmarked with our material contribution from the product with our competitors, even competitors who are 5 times more of our volumes. The advantage for other players basically is the economies of scales, and which we don't have, and we don't intend to expand there as well. So eventually what happens is if the prices go up, my fixed costs most likely will not go up, and that would eventually make our EBITDA look much better, the margins to go up.
Right. Got it, sir. All the best, and thank you for answering all my questions.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management.
Thank you everyone once again for joining the call, and hope we've been able to answer your questions. If you have anything further, you can connect with our IR advisors, Valorum, for any further clarifications. Thank you once again.
On behalf of Arihant Capital Markets Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.